These are in listen-only mode.
Hello, this is Christine Linke, Webcast Manager at PRMIA, and I am pleased to welcome you to this PRMIA webinar. Today, Dr. Robert Fiedler will present transfer pricing of liquidity risk, distributing the cost of Basel III. Dr. Fiedler is the leading practitioner of liquidity risk management at Liquidity Risk Corporation. He has spent over a decade in the Treasury and dealing rooms of numerous international lead banks as a money market liquidity manager, trading interest rate products and derivatives. Please feel free to submit your questions to the presenter via the question pane on the right-hand side of your screen at any time during the presentation. Questions will be answered at the end of the session as time allows. Following this webinar, a link to the presentation will be emailed to you along with a link to the recording of today's webinar. So now, Robert, I will turn the presentation over to you.
Thank you very much. I'm Robert Fiedler, and I would like to talk about transfer pricing of liquidity risk. The agenda is following. There's one block getting started where I want to talk about the foundations of liquidity risk management. Can only be liquidity risk management measurement in a nutshell. Then we come to the idea of funds transfer pricing methods and processes, the way they are implemented in banks and possibly the way they should be implemented. And finally I want to talk about what's new in Basel III. You know, there's liquidity relation there, especially the LCR, and the transfer pricing of a bank has to fit into that. Okay, shortly about myself and my company, LRC, Liquidity Risk Corporation. We are small liquidity risk and ALM boutique. We focus on liquidity risk in banks since more than a decade. Actually, it's 2 decades. We do liquidity risk methodology and policy consulting, and we build liquidity systems, and we of course we design and architect them and implement them. We do a lot of in-house seminars, consulting, banks like you see here, and we have successfully built liquidity software solutions, or software solutions focusing on liquidity risk in Deutsche Bank. That's where I come from. I did Lima, the application there, but it also in Commerzbank, DK, and so on and so forth. One of the latest clients was BNP Paribas Fortis. Okay. Now I'm coming to the foundations of liquidity risk management. The first thing is we have to consider insolvency and illiquidity is somehow used in, well, not clearly distinguished in its use. So what do we mean with insolvency? Either we think about over-indebtedness or illiquidity. If you think about over-indebtedness, we have a structural risk. That means the risk that the value of the assets minus the value of the liabilities is less than the equity. Or if I would put the equity on the left side, this is negative, so negative equity. The over-indebted company is normally, or is not automatically illiquid now, but over-indebted companies will become illiquid in the long run or in the short run unless they recover. And that's what every over-indebted company is hoping for. They don't want to become illiquid and push this ahead. So they hope to become liquid again. If you talk about illiquidity, this is something acute, and simply the available cash is less than my payment obligations. If I would want to fulfill my payment obligations, I would need more cash than I actually have. Okay. An illiquid company is not automatically over-indebted, and on the other hand, illiquid companies can become over-indebted. So these things are closely linked, but they are not the same. Today, we want to focus on illiquidity risk, which is the inability to fulfill contractual obligations when they fall due. Not on insolvency risk, and we do not focus as well on liquidity-induced value risk, like risk of opportunity or real losses due to increasing expense of funds the bank has to get, or decreasing income from surplus fund, decreasing price of assets, and all these things. So just on illiquidity risk. As I said, we have to develop a little theory in a nutshell, so we cannot be too broad today. Okay, so what's the objective? We think of the bank's nostro as the single point the bank interacts in terms of cash flows or payments with the rest of the world. So if I have the magic line where I have above more liquidity than I need, and below the part where I have less than I need, I want to measure how far my bank might go down into this doom amount. On the other hand, I want to measure what is the bank's counterbalancing capacity. What is the bank's ability to counter these negative exposures. In this example, the counterbalancing capacity is not enough. There's a negative headroom, even if the bank is doing everything they can do, assumedly, in the counterbalancing capacity against the assumed negative liquidity exposure. It is not enough. So normally it should be something like this. The counterbalancing capacity should be bigger than the future exposure, and there should be a positive headroom. Okay, a little bit technical things. The idea to measure liquidity is that we say we have a complete list of all financial transactions the bank has contractually concluded, and then we can describe every individual transaction as a series of payments in time. Unfortunately, we can only do this for historic payments, because they can be known in principle if I find them. All future payments are known by design, because we don't know the future. Therefore, we need to forecast them. And we do this with cash flows. In this terminology, cash flows are abstractions of payments. And they are, or they can be a little bit different, having different attributes. For example, you have stochastic cash flows. A cash flow might have no target account. This only comes when the payment is already known and the counterparty is giving the target account. Things like that. Internal transactions may not result in payments, but in account transfer. That's very important to note. And not all transactions have payments and are thus liquidity bearing. Some of these transactions on this we could simply forget, because they will never have liquidity effects. But in addition, we need to look at things which are out of the closed financial transactions world, which are things like tax payments, salaries, if the bank buys equipment and whatever. All these things go into the nostro. The bank in one or the other way pays out through its nostros or receive money through its nostro, but there will be nobody in the bank writing in financial transactions, making a tax payment like 500 million going out and there is no backside of the deal, nothing's coming in back or something like that. So these things need to be regarded as well. Good. The point is, as we are looking at things which are happening or which will happen in the future, we have uncertainty. That means if we generate cash flows, contractual cash flows, then they need to be generated under certain scenario assumptions. Even if I have fixed cash flows, they require a scenario assumption. And if it's simply the assumption scenario, all cash flows are paid as scheduled. Some other cash flows are market dependent, and other cash flows depend on the exercise of options, which might then require the prevalence of market rates, and they can include counterparty decisions, which can be quite complicated. A completely different kind of things compared to the contractual cash flows, which already exist in the bank because there is a contract, are hypothetical cash flows. They stem from transactions that do not exist yet. Okay, we want to build these things, generate these things on the scenario assumptions. So you have to think a little bit about a scenario. Scenario describes the potential state of the future and is of course determined by assumptions. And there are two types of scenarios. An exposure assumes the execution of option the bank is not long. So for example, it would be contractual roll-off. It's everything that happens to the bank and where the bank is not actively trying to change this. The forward liquidity exposure in this sense is an exposure. On the other hand, you might have strategies where strategy describes the bank trying to exercise options, long options, to pursue certain policies. For example, to counterbalance a shortage. That's what we had in the counterbalancing capacity. Normally we need a target and then the strategy reacts to the exposure. You need exposure and target, so therefore counterbalancing therefore strategies are much more complex in a modeling sense than exposures. So for example, and it's a difference to other risk like market risk. In market risk and in credit risk, the extreme scenarios seem to be the really complicated issues, whereas in liquidity risk it's really complicated to model a going concern properly. So because there you have the problem that they are exposure, something is happening to the bank, but on the other hand you assume that the bank is doing something against it, which is for example replacing maturing assets and liabilities in a way that the bank is going concern. Although this sounds theoretically good, in reality strategies can not always be clearly separated. So for example, the replacement of a loan can be seen as a weak option exercised by the counterparty, but on the other hand, as an option the bank is short versus its business plan. If the bank has communicated before that it wants to grow its loan business, it's not in a position to turn down every potential counterpart who's asking for a loan. So there is certain kind of option which cannot be directly compared to financial markets options, like you know, I call them liquidity options, and they have something which is similar to real options. By the way, I've recently written a book. It's just out now, and I try to do, in the part of the book, I try to develop a theory of these things. Okay, but today we cannot go really deep into it. We just fix the simple things. So if I look at one transaction, I want to generate its future cash flows and inventories, cash inventories. Quite some people say that in order to do liquidity risk measurement, you just need the future cash flows. I do not fully agree with that, because the point is, if you, for example, would look into a portfolio of loans from a liquidity perspective, you would simply see that the loans are generating positive cash flows, but what you do not see is how much liquidity has the loan portfolio moved out of the bank. So in order to get an idea about the providers and users of liquidity in a bank, you need cash inventories as well. So the nostro of the bank with the central bank is the archetypical inventory, cash inventory. Okay, the future cash flows of a transaction are generated under a scenario. So we forecast or generate all the future cash flows in a certain day, and then we aggregate all inflows and all outflows on that day, and then we generate the cash flows, the net cash flows of that day. The future cash inventory of a transaction is built in a way that we have to start with something. So the transaction was done by the bank a year ago. So there had been some outflows and inflows possibly. So we need to discount or at least sum up this historical transaction, and this is our starting point. In T0 today, we just take this starting point from the day before and add today's cash flows. Tomorrow we do the same. We take the starting point as of today and just add tomorrow's cash flows, and so on and so forth for the next n days of our scenario horizon where we want to do this. This looks like, well, quite simple and straightforward, although there are some assumptions in there intrinsically. It means that we've said that all short or long positions, inventories of cash, are repeatedly funded or placed until the next payment day. So if I have some money with the central bank, I assume that I can place it in the market, and then it comes back tomorrow morning and I have it again. The point there is we're neglecting the fact that a nostro at the central bank cannot be short, because the central bank would stop us from executing transactions before our nostro will be short. So strictly speaking, it is impossible to have these negative positions. Okay, we traditionally neglect the interest rate effects, although there could be a big effect in the long run, and we have to be aware that we cannot do transactions with multiple currencies, so we have to calculate this forward cash inventories for every currency separately. If we would put an outflow in one currency and an inflow in another currency together and aggregate them, then we would already do some liquidity risk mitigation, which is not so clear if it can be done, because as we've seen in the last crisis, the mitigation of euros and dollars was not so straightforward. Actually, it killed some banks. Okay, in a picture we have something like that. We have the cash flows given. We need a starting point, and then from that these cash flows determine the next inventory and then the next inventory and so on and so forth. So these are the elements we really need to calculate. Now, if we apply this to the bank, the forward or future liquidity exposure, FLE, we want to measure the exposure to illiquidity risk in the future, again under a special scenario. So what we do is we start with a complete list of all liquidity-bearing financial transactions in the bank, and we sum up the forward cash inventories of these individual transactions to get the FLE in the future. Okay, again, the assumptions are the FLE can only be done for every currency separately. The problem is if the inventories of the individual transactions cannot be determined as of yesterday because they are unknown, not in the systems or whatever, we have to assume that all inventories as of yesterday go into one bucket, and this is the FLE -1 of T-1, actually the nostro, or maybe the sum of all nostri as of yesterday. We need to add non-financial transactions if they're not already there, and we need to properly see the internal transactions, and then we have to think about transactions which are external but do not really have an impact internally. So, for example, if somebody is, if the bank is paying out a mortgage to somebody, it's an external transaction in the bank's records, but in fact the bank will pay on the day, tomorrow say $100,000 to the account of this client, which is within the bank, and a LORO account for the client, and this has no external movement, so it does not hit the nostro. On the day after that or some days later, however, this long account has created a liquidity option, and the client might then generate an outpayment from that by basically saying, well, this money has to go to the owner of the house, and then it depends if this guy has an account with the bank or it's a separate account, and if it's a separate account it would be strictly an external cash flows. So just to give you a little idea about the complexity of that, the realization is what we do all the time. We build systems, and in these systems you can basically look at the term structure of the bank, expected cash inflows plus expected cash outflows minus, plus minus are the net flows and the FLE as I described it, and then you can see the FLE in a graphical way. And of course you need scenarios and so on and so forth, but it's not our topic today. You just need to do, I just wanted to say that you have to do a lot of slicing and dicing to get the cash flows or the results out of that, which has nothing to do with the complicated methodology. It's simply the fact that you have to, in theory, find every cash flow in the bank. And finally, you somehow create reports and submit them internally or to the regulators and so on and so forth. Okay, this was the first part of the liquidity stuff, the forward liquidity exposure. If we look in the risk management process, we ask, so why do we need a CBC, the counterbalancing capacity? As we said, normally in risk we measure the exposure, we determine the ability to bear risk, and then we steer the risk taking. If we look for market or credit risk, you have the VaR and we take capital as a measure against the risk, and then we do limiting, pricing, and so on and so forth. The liquidity case, the problem is we can have the FLE as a measure, and maybe there is a risk-adjusted cash flows, but it's still an FLE, and the problem is that capital is already in the exposure. It has been paid in and somehow used by the bank. And even if we could find where it is, the problem is the capital has now a term structure, and we might need it on short term for liquidity purposes, but it might be invested long term. So we need a substitute for capital as a risk buffer. This is the CBC. So the CBC is a specific scenario, a strategy with a target to simulate the bank's maximum possible cash inflow generation. And it models the possible things. We could have a balance sheet expansion by secured or unsecured refinancing through repo or borrowing from new clients, possibly under assumed credit lines or existing credit lines, which are credit facilities. You can issue debt, and then you can have a balance sheet reduction. You sell assets either finally or you sell them temporarily and buy them back. These are the possibilities you can use there. So how does this work in practice? Basically, you look at one security or the portfolio of the bank security. They have a term structure, or possesses. I call it according to the forward cash inventory, the forward asset amount, and then the next day it goes up, stays constant, goes down. So all these changes after T0 today are the effects of pending deals in, say, securities. Okay, and then you assume that you can repo a certain amount of that the next day as well, third day as well. But then at some point, the first effects from selling these securities kicks in. You might have started selling already in T0, not only in T3, but the effects are kicking in at that time. And then you repo the rest, and you see the difference between the sales liquidity, which is expensive, and the repo liquidity which might be less expensive, but the repo has to be renewed every day. So this is the counterbalancing capacity, and so we get out the balance sheet liquidity out of that. So what have we done? If you look at the forward liquidity exposure, we cannot say where's the real problem in this term structure. Here in the beginning, the negative position is not so bad, but it comes quite early. Here, the negative position is much worse, but the bank has longer time to work against it. So if we calculate the counterbalancing capacity and just flip it around for convenience, so to calculate the minus CBC to see the difference between the FLE and the CBC more easier, we can see that the problem was already there, because there was already liquidity available very soon, and here it takes some time to get get to there, and obviously the bank in this example is relatively near to default. Okay, and what have we done? Actually, the CBC. Well, we have firstly done the FLE, where we said there are no options, or there are short options which can exercise against the bank, and then the CBC comprises all long options the bank has to do something against it. Okay, that's the liquidity in a nutshell. Now we come to transfer pricing. Basically, transfer price, you all know that, so I want to put a spot on that. There are two broad methodologies. One is a flat mixed rate, where you have an average liability rate normally, and then you have individual fund transfer pricing. The average rate, the first one, is mainly used in classical asset-driven bank, where you assume that you replicate every asset at an average funding rate. And normally you don't use it for liabilities because this thing does not represent term structure of asset. And if it's recalculated, it might change, and then the transfer price might change as well, and the profit calculation might change as well permanently. Implicit assumptions are that the current liability mix can be regenerated to fund every new asset. This might give the wrong steering impulse that refinancing asset growth is only possible at higher rates, and in this case our assumption does not work, and we would give new loans and only fund them at higher and eventually produce losses, or at least smaller profits. Okay, that's this part. The other part is the individual replication or match funding, where every originated transaction is linked to an individual replication transaction. Of course, the characteristics should match amount and tenor. This is a thought experiment, but it could be executed in principle, in reality. However, it would be cumbersome if the bank would do that on an individual basis, because then it would have to deal with a long list of small amounts and the odd tenors and so on and so forth. So the usual solution is that there is an internal central refinancing department. Let's call it the Treasury, even if in your bank it might be called in a different way. The Treasury gives a loan to the originator, which matches the external loan exactly up to margin. We have to describe what it is. The originator's view is that internal deposit matches his loan, and the point how the Treasury refinances out of scope of the originator. This method can be used for assets and liabilities both. And it could be seen as an internal sale or purchase transaction with the Treasury. So just look at it. We have the external counterparty. We have the originator who wants to give 10 million loan and will receive 7%. Now he asks his Treasury, how can I refinance that? The Treasury has the possibility to either go into internal funds, ask an internal counterparty to give the cash, or go to the market outside. Depending on that, it might get different rates. If it has fixed the rate, basically the margin in this case is 7% to the outside, 5% to the inside, 2%, and the originator is well off because he has pushed everything to the Treasury and does not want to care what they do. So there are almost Chinese walls between these departments. It could be a replication seen as an internal sale of an originated transaction, because a loan or deposit is a forward purchase or sale of cash and can therefore be sold or purchased as well. So the originator's view is that external assets are internally sold. The assets are purchased and eventually liabilities. The assets are sold and the liabilities are purchased from Treasury, and the whole thing is irrevocably. So the originator gets rid of all responsibilities. No market liquidity risk management for him. The question is, what's with credit risk? Treasury pays out a margin, and the profits are ring-fenced, or the earnings are ring-fenced. The Treasury point of view is it buys or sells the internal transaction, the originated transaction internally, and this is irrevocably, cannot be changed after that. And then it can match fund externally, but not necessarily. If it leaves the position open or partly open, it might encounter interest rate or illiquidity risk, which could result in profit or loss or illiquidity. Okay, so Profit of the bank is the profit of the originator plus the profit of the Treasury. The risk of the bank is zero in the originator, and it sits in the Treasury depending on how the Treasury has purchased the asset from the originator and sold or hedged or whatever it has done with the assets. Okay, so if we have a picture showing this, basically the loan is sold onto the Treasury, and then if you neglect the intermediary interest rate payments, it simply goes back at the maturity like that. I think it's a good way to look at these things, although very few banks use this internal sales and purchase agreements. In reality, there are legal constraints and operational complications. But it's a good way to look at the problem. Okay, what are the match replication principles? First thing, it's irrevocable. It stems from the Treasury's hypothetical external replication, as it could be done at the time of the origination. Here, it assumes that the originator's transactions' future cash flows are taken as they have been forecasted with best effort in T0. So uncertainties are at that stage ignored. We do not think about at a possible internal replication at better rates in different departments or whatever. And it does not matter if the Treasury concludes the replication or not. For the mechanism, for the Treasury, of course, it matters. The hypothetical replication should be as realistic as possible, okay, and then we might have secondary effects like cost of collateral, cost effect from FX, and so on. What are the issues? The originating department has no further responsibility for the replication. An eventual deviation of the occurring payments from their forecasts, which is very important, because the replication transaction cannot be changed in the hindsight. The crucial point is then that from number one, the prices of the replication transaction rates, they should beforehand encompass all deterministic cost elements to be correct. And if they deviate, then the costs of eventual detrimental changes, the difference between realized and forecasted payments, should be also ex ante included in the replication transaction. Okay, now for liquidity hedging, this is straightforward. For interest rate hedging, we have more technical efforts. Look at the following. Liquidity replication. We assume this is the originated transaction, TO. It has future payments which we forecast, and then the replication is simply the Treasury says we generate a matching internal replication with symmetrical cash flows. It's just negative cash flows of the originated transaction. The sum of this is illiquidity risk view. The problem is we cannot calculate earnings or PVs, NPVs, or whatever out of that, because these two cash flow streams just net out and their NPV is zero. So if we go into the interest replication, we have to be a bit more technical. I assume that, you know, structural curves, zero coupon curves, discount factors, and so on. We can calculate the NPV for two transactions and can compare them. So one thing would be to base the replication just on the net present values. Another way to look at this is we calculate internal rates of return. Basically, the internal rate of return is given by this equation. You discount the cash flows in a way that discounting that the result is zero, and in order to do that, you have to change the discounting rate, the internal rate of return, accordingly until the equation gives 0. The problem that is this method is not really exact because it's completely time independent. So if you have real interest rates of 2% in the short term and 8% in the long term, has no effect on this calculation. So what do? For the interest rate replication, we take first the risk-free rate and the risk-free curve by the market. We have the discount factors, and then we do the following: we take our originated transaction and transform it into a plain vanilla floater with the same nominal, the same term structure and NPV, and the rate rho plus rho F for floater, where there is a reference rate rho. The nominal is the same as in the originated transaction. The redemption cash flow is minus this rate, and the interest rate flows are given by the floater rate. And this PF now needs to be determined, and is determined by the NPV neutrality. So the NPV of the floater is just the sum of the discounted originated cash flows, and they are the same as the discounted cash flows of the floater. Okay, if this is not 0, the floater is of course not risk-free. The next step, we transform this plain vanilla floater into a risk-free replication floater with identical nominal term structure and NPV, but the internal cash flows are given by this formula, where row 0 is now the required 0 NPV, or is determined by that. Difference between the rates of the two floaters can be interpreted as the margin of the originated transaction relatively to the risk-free curve. As the bank is normally unable to fund at the risk-free rates, we have to put another liquidity premium on top of that, the P, so the profit margin can be equated as the rate of the floater minus this margin minus the risk-free rate. Okay. The next thing is the margin of the transaction is so far unhedged, so you might think if you want to hedge the different floater as well, but you can do this or can leave it. Okay, what have we done? The originated transaction is represented by this first floater, which is equal in value to it. The plain vanilla floater can then be decomposed in 3 components. The risk-free floater, the floater which represents the liquidity margin, and the floater which represents the profit margin. Okay, now if you take a very short reference rate, then you can roll out this every day. So I want to just change. Okay, there are some issues. How do you really determine the real basis curve? And then things like banks have planned funding matrices where they say, well, we want to just show you something like this. Hold on. So, sorry. They want to say, okay, I have a certain percentage of funding with interest rate swaps, short-term funding swaps, and so on, uncovered refinance, and then I have bond issues which are uncovered and covered, and so on and so forth. Things are quite complex on that side. If you send me an email after the presentation, my email should appear at the end. Again, I can send you two chapters from a book where I basically deal with these things in a more technical way. Okay, the next thing is the price of the uncertainty of the originated transaction. And the problem there is the Treasury has an exposure which is on the interest side as well on the liquidity side, and it has to deal with both things. The problem is an interest rate and liquidity view. We look at different scenarios. In the interest view, everything is additive, and we can build mean scenarios. And the liquidity scenarios, we want to have different scenarios showing more extreme situations. Okay. So we have forecasts. Well, we have the situation where forecasted and real cash flows differ. And in this case, we have linear risk. We know that where we change the expected NPV by this uncertainty, but it has to change detrimentally. This can be seen as a risk premium because it lessens the expected profit. If we have nonlinear risks, we might have perturbations of the cash flows, but not necessarily of the expected NPVs. So there we need a buffer, which is capital for the value risk and the counterbalancing capacity for the illiquidity risk. And in both cases, the cost of capital needs to be calculated, or the cost of the CBC needs to be determined and put on top of that. As just a summary, well-known facts, expected and unexpected risks. So what do we have? We have credit and operational risk. There is an expected risk in credit and unexpected risk, and it depends on the hedging process. So have you included it in the FTP process to say, do you have a credit treasury? In a market risk, the expected risk is neutralized by the interest replication, which is normally a negative cost of carry, which is a profit and therefore ignored by the regulators. And if we look at the unexpected change, we have interest rates which could be hedged by the capital, like war. And then, of course, we have second-order effects may stem from realization of credit risk. So, for example, if a loan does not pay back, the according hedging structure, refinancing, is empty and might create a risk, which is should be equally distributed, no expected but unexpected. So you might add some capital on that side. Liquidity risk. Then we have the expected risk, which is already expressed in the liquidity costs of the transaction, the replication. The Treasury view might differ from that because it has not hedged possibly, and the unexpected risk comes from unexpected changes in the real cash flows and can only be covered by the counterbalancing capacity. So this is this point. Okay, what's liquidity specific now? If there would be no uncertainty in the cash flow, the liquidity spread covers the economic costs of neutralizing liquidity risk. If there is uncertainty in cash flows, there might be non-detrimental changes, so you just have more liquidity than replicated. This is okay, no risk. But if it's detrimental, either less liquidity or in different times than you would expect it or have replicated it, this can only hedge by funding additional assets and converting them into liquid asset. And this is the CBC. The cost of the CBC calculates as the income of the assets minus its financing expense. So you have a German Bund basis 40 basis points minus LIBOR or whatever reference rate, and you have to compare it against the funding rate of the bank, which is, for example, 80 basis points above the same reference rate, so the costs are 120 basis points. Okay, but this has to be only done for the expected or unexpected change from the uncertainty, not for the whole deal. Okay, there is additional potential loss if the CBC is exercised in reality, because if you really need it and transform liquidity into, or transform securities into liquidity, you might sell them and then you have substantial losses, or might have substantial losses, or repo them and then have smaller losses. This has to be added. But very important, there needs to be a kickback to the business if the originated transaction provides liquid assets, collateral for example, which can be used in the CBC. So if you take a central bank eligible loan, for example, then you can substitute securities which you would need to hold in the CBC by this loan, and therefore the costs are going down for the whole bank, and so you need to kick back. Okay, now what's the price of the compliance with Basel III? Basel III, you all know it, is a global framework, and there is a liquidity standard within, and this liquidity standard, there are two things, the LCR and the NFSR. So the one thing is short-term, 1 month, and the NFSR is long-term. I want to focus on the short-term, the LCR, liquidity coverage ratio. Okay, in the liquidity coverage ratio, first 30 calendar days you compute the bank, accumulates its total net cash outflows, compares them with the stock of high-quality liquid assets. And this is the way it appears in, sorry, it was too fast. This is the way how it appears in Basel III. Okay. Now, what is the stock of highly liquid assets? The idea is assets which can assumedly be converted, easily converted into cash without generating substantial losses, whatever this may mean, within the time horizon of 30 days. They cannot be encumbered or rehypothecated. We have two categories, the better ones, HLR ones, with a 0 risk weight, not with the bank as an issuer, and level 2 with a risk weight of 20%, but then you need a minimum haircut, and you need to make sure that the level 2 assets do not comprise more than 40% of the total stock. Okay, the HLR should be central bank eligible, but not every central bank eligible asset is automatically HLR. Okay, now what's the problem? You have the outflows and the outflows for these total net cash flows, and there you have a rather strange calculation mechanism. The TNCO, the net flows, are determined by taking the outflows minus the inflows, but up to 75% of the outflows only, which reflects that inflows are less certain than outflows, but in a very crude way. These things are not so important. Let me go to an example. Here I have calculated the cash in, the cash out, the cash net in the way I described it to you, the forward liquidity exposure in an economic scenario, and then I have calculated the TNCO as it is determined by the LCR. In this case, it's one of the rare cases, sorry, the FLE is more negative than the TNCO. The reason is that the TNCO has this minimum function, which normally is creating a worse number than the FLE, the correct addition and subtraction, but in some cases it can happen like that. I've done this with an example where I used stochastic cash flows in the balance sheet, and then every 50 times in stochastic experiments with the FLE and the TNCO, the outcome was that the TNCO was less than the FLE was at one point less than the TNCO. Okay, now the question is, how can a bank improve its LCR? What are the reasons for bad LCR? Well, it's too many outflows from maturing liabilities, not enough assets. The problem is, if the bank would be fully match funded, it still would have to reserve 25% extra extra HLRs because of this 75% rule. That means even a fully match funded bank cannot assume it's flat in the LCR and might need to improve the LCR. What are the tactical improvements? You can decrease the denominator or increase the numerator. The problem is, if you buy more HLR, you worsen your TNCO because you have to refinance them. And then you have to look at the period return of the HLR, which needs to be risk adjusted, held against the period of the new refinancing, which is necessary, and then the adjustment has to be made for the usability time of this LCR because of the HLR, because a new bond cannot be used in the HLR in the last month of its life. So if you would buy very short bonds, which would be the cheapest one, it doesn't work because they are ineffective in this calculation in the last month. So how do you do it in practice? You try to find such complicated structures, like you could purchase additional HLR, you could decrease in total net outflows, and then you have to think about refinancing, which are cross effects. So what I have done here as an example, I basically say, what can I do? I have outflows of 100, inflows of 75. The TNCO is then 25, no cap. Yeah, 75% cap doesn't kick in. Now I have additional 5 HLR and additional 5 TNCO, and then if I look at it, the improvement is 0. Even if I would say, if I add new class 2, level 2 assets, the effects can be negative. So in a nutshell, these things need to be calculated in detail and depend massively on the situation of the balance sheet. Okay, let me go. I'm running out of time. That's what I've already said. Excuse me. This was the last slide I wanted to show. So for the bank, it's a complicated situation because it depends on the individual balance sheet. For the originator can always make the assumption that his transactions are match funded because this was the contract in the funds transfer pricing mechanism, even if the Treasury has not done that in reality. So in an economic view, the originator's inflows and outflows are fully matched. In the LCR, however, there is the 75% rule, which means that 25 of the position or 25 of every individual deal needs to be covered by new HLR. So for this 25% HLR, the difference between income and funding expense is a regulatory cost, and the originator should bear for that. And of course, you should try to find out how to get to the optimal tenor. For the Treasury, the situation is different because eventual additional costs more than these 25% above, stemming from not match-funded replication. They cannot be allocated to the originator because they've been generated by the fact that the Treasury has not been match funding the position but left it open, so they have to bear it. So the situation, cost situation for the bank and the cost situation for the originator and for the Treasury is very different. The problem now is if you come up and try to put this in an FTP system, the existing FTP is massively disturbed by that. And I think the only way to mend that is, as all the things we've seen before only work for new business, the bank would need to reset the FTP and then restart it newly with the residual maturities of the existing transactions, but with the old rates, and then in the future calculate additional costs from the 20% HL, 25% HLR on top of the transfer pricing for the term structure. Okay, I think this was everything I wanted to say. Can we come to questions?
Yes, Robert, we have 2 questions that are waiting for you in the question pane. I'm not sure if you can pull that away from the GoToWebinar screen and expand it, or if you'd like me to read them aloud.
I'll just try to, well, I see one. This was the question, shouldn't be the FCIs, the forward cash inventories, be a part of the counterbalancing capacity? Well, in the end, the FCI, the forward cash inventories and the counterbalancing capacity needs to be added. Yeah. So if I have this again, so where is it? They need to be added, and therefore you could see them as a part of the counterbalancing capacity, or these two things together. But if you think, here I am, sorry for that, took some time. If you think at this, it's relatively clear that it's much nicer to split these two elements, because in the FLE you treat everything except the long options, and therefore the long options exclusively go into the counterbalancing capacity. That means if you're doing scenarios later, you can say, okay, I have exposures for the FLE, no options and short options, and there are different scenarios for the exposures, but in every scenario I can hold against that the counterbalancing capacity, and even for one exposure scenario I could look how it would work out to use different strategies, different counterbalancing capacities. So for example, I could look at what would it be if I just match fund my shortage, what would it cost me, and I could think about what would be if I would say match fund the whole thing with a 10% extra buffer, or what would happen if I fully match fund it, in the sense that if I fully use the counterbalancing capacity, in the sense that I create as much liquidity as I can do. So I can you read the questions? I cannot see them.
Otherwise, if you can expand the box by dragging the arrow down on the right corner, we have several more questions. One is the under...
No, I see it, yeah.
Are you seeing them? Okay, good.
Oh, no, I see it. Okay. So this was, there was one question before. FCIs are realized. Why do I consider it for liquidity considerations? Well, the point is the FCIs, they have two components. One are the historical FCIs, the ones that have been derived from the historical activities of a transaction, and the others are the future FCIs. So what I do not really care about how the forward cash inventories have been 5 days ago or whatever, but I need them today to start the future. If I do not know that a loan has generated 100 million outflows some time ago, I cannot interpret the fact that it's paying back 5 million of interest and another 5 million of interest correctly. So I need them, is the answer, to distinguish the liquidity providers in a bank from the liquidity consumers. And with liquidity providers, I do not mean liquidity providers in the future or consumers in the future. I mean the ones which have already provided liquidity or consumed liquidity in the bank, and therefore you need these FCIs. Okay, I can't hear now if this was the answer was enough. So I have then the next question: would you give a liquidity premium to a retail liability? Well, the point is, if I can prove the stickiness of, for example, in savings deposit, then I would give a premium. In other words, I would map a longer maturity to this retail liability, say savings deposit. The problem for me seems to be at that point, if we look at the last crisis, 2008, what happened there was that when it becomes really disastrous, for example, French president told everybody in France that savings deposits are safe and nobody will lose money from that, and so on and so forth. And Frau Merkel in Germany did exactly the same. So I think this was a good thing, because at that time it well, eased things a little bit, because people were not taking savings deposits away from the banks. Actually, I was in a bank which went under in the crisis in September 2008, and in fact there was no problem with the outflows of savings deposits. So from that, the regulator said this is a very good thing. Savings deposits, we want to estimate them highly and give a premium to them. My point is, I think in the next crisis, which seems to be very near to us, it might not work that countries are saying, well, it will be, savings deposits will be insured by the government, because a lot of people, depositors will question the ability of the governments to do so. But yes, I wouldn't value it with 1 or 2 days outflow with its first possible outflows. Next one is the underestimation of inflows the problem that causes the costs for bank. So, sorry. Well, the costs from the bank, I'm not sure if I understand it. The costs from the banks are basically coming from holding risky assets and being pushed into risky assets for performance reasons. So I think it's not, but maybe I misunderstood the question. Okay, there's again one on the FCI. So in that case, shouldn't the FCI be not only the previous cash flows, but as a whole the entire cash inventory? And the question, the answer is yes, it should be the cash inventory, and it is accumulated in the nostro of the bank. Okay, now it's some more question, not only the previous cash flows. Question, in the transfer price match funding, how credit risk is treated? Who bears the risk? If the originator does Treasury match fund, taking into account cash flows after losses? Yeah, well, the point is, that's a good question. Some banks have a credit treasury, so they take out the risk in form of a negative margin the originator has to pay, and then insure credit risk. It can be debated if this is a good thing. Other banks are saying, yeah, this is nice, but in the end, the originator should care for the payback of the cash flows. I would go for treasury credit treasury solution because it makes things more transparent. There's one thing about OTC trades, and do Monte Carlos runs and so on, option theory. The simple answer is I did this when I was with a Canadian company which specialized on things like that. But now I think most things of this kind are not substantial in a liquidity risk view. If you have a market risk loss of 1.5% in a portfolio, it might be gigantic loss. But in terms of pure liquidity, illiquidity view, it's not substantial material. Okay. Have we some more? How can we differentiate first the recognized, second the treat, two kinds of future cash flows? Number one would be an expected cash flow with uncertain amount, unexpected cash flow. Well, the point is, there's much said about uncertainty of cash flows. Firstly, I want to say every cash flow is uncertain. It's something in the future, and it only works on the assumption of certain scenarios which will prevail in the future. The problem which seems to me there behind this technical question is, if you start to model with cash flows, you are extremely in narrow bounds because if you have things like a credit risk, a loan which is not paying back, and you've firstly picked up the cash flows, what should you do with the cash flows? Do you raise them while they're not paying back? Do you defer them for months and then again for a second month and things like that? So all these things which should be done do not work at the cash flow level, but they work at the level of transactions. So basically you have to capture the transaction, and then on the basis of every transaction you have to newly create the cash flows from the transaction, rather than taking cash flows and trying to mend them in a certain way. Okay. Christine, are there other things?
No, Robert, that is everything.
I have not seen. That's everything.
Yeah, you've covered all the questions, so I'd like to take this opportunity to thank you for your wonderful presentation today, and thank everyone who joined us on the call today. The recording link for today's webinar will be sent to the audience in just a few hours, along with a link to today's presentation. Thanks to all for attending.